Today we will be discussing departmental income statements. The management and evaluation of a company's performance can be easier managed if we divide the company into smaller units, often called departments, divisions, or segments. Examples include geographic regions such as North America or Europe, separate product lines such as speakers or headphones, or departments within a retail store such as electronics or hardware. Most departments can be classified as either cost or profit centers. A cost center does not generate any revenues, and therefore is only evaluated based on costs that it incurs. Examples include manufacturing departments or service departments such as accounting or purchasing. A profit center incurs costs just like a cost center, but also generates revenues. Profit centers are evaluated based on both their ability to generate revenues and their ability to manage costs. An example might be the electronics department within a superstore. We can create departmental income statements, which calculate the net income for each profit center. There are three types of expenses we will need to determine and include on the departmental income statements. First, there are the direct expenses, which can be traced directly to a specific department. Second, indirect expenses like rent, utilities, or advertising that apply to several departments must be allocated to each department. This is done using an allocation base that has a causal link to each indirect expense. For example, utilities might be allocated based on the number of square feet the department occupies. Third, the service department expenses, which are the cost centers, get allocated to the profit centers using an allocation base for each service department. For example, the cost of the accounting department would need to be allocated between the profit centers, such as the electronics and hardware departments. Let's take a look at an example. Let's keep it relatively simple and consider a company with only one service department, which we will call administration. And there are also two profit centers, which are the hardware and electronics departments. Each department's sales, cost of goods sold, and direct expenses are showing now. The administration department doesn't have sales or cost of goods sold because it is a cost center and therefore doesn't generate revenue. The company also has two indirect expenses. Remember that indirect expenses need to be allocated to each department. The rent is allocated based on the number of square feet the department occupies, and the advertising costs are allocated based on the dollar sales. We will also need to allocate the cost of the one service department of administration to the two profit centers. Administration costs are allocated based on the number of employees. We will determine the total cost of administration later. Here is the template for our departmental income statements. Remember, we only create departmental income statements for profit centers, to which we have two, the hardware and electronics departments. The sales and cost of goods sold are given here, so we can simply copy them over to the departmental income statements. The gross profit is just the sales minus the cost of goods sold, which comes to $160,000 for hardware and $185,000 for electronics. The direct expenses of salaries and supplies can also be copied over. We need to take a detour now to calculate how much of the $40,000 indirect rent and $80,000 indirect advertising costs should be allocated to each department. First, the rent expense of $40,000 is allocated based on square feet and applies to all three departments. Let's assume the square feet occupied for the three departments is as shown. We would have to be given this information somewhere in the problem. We must add up the total number of square feet from the three departments, which comes to 1,000. Then we can divide the square feet of each department by the total to get the relative percent. 200 for administration divided by 1,000 equals 0.2 or 20%. 500 divided by 1,000 for hardware is 0.5 or 50%. And 300 divided by 1,000 equals 0.3 or 30%. Of course, the percentages add up to 100%. Next, we can multiply each percentage by the total rent expense, which is $40,000, to get the allocated cost. When we multiply each percent by $40,000, we get $8,000 in rent allocated to administration, $20,000 allocated to hardware, and $12,000 allocated to electronics. The rent allocation sum to the total rent expense of $40,000. We can do the same thing for advertising, except common sense tells us that we shouldn't allocate advertising expenses to the administration department because the administration department does not benefit from advertising. Instead, advertising is only allocated to the operating departments of hardware and electronics, and the allocation is done based on sales dollars. So again, we add up the total sales for the two departments. $225,000 plus $275,000 gives us the total sales of $500,000. We use these same sales numbers previously as they were given to us in the previous slide. We then divide each department's sales by the total of $500,000 to get 45 and 55%. Multiplying each percentage by the total advertising expense of $80,000 gives us $36,000 of advertising expense allocated to hardware and $44,000 of advertising expense allocated to electronics, which totals to $80,000 in total advertising expense. Now we can return to the departmental income statements to update them with the indirect cost of rent and advertising. Now that we have included the indirect expenses, we must allocate the service center cost of administration to hardware and electronics. To do that, we first must determine what the total cost of the administration department is. Here is a modified table from what we showed at the beginning of our example with just the direct expenses for the administration department. But remember, we allocated some of the indirect cost of rent to administration, so we must include that here too. Looking back at our rent allocation table, we see that $8,000 of rent should be allocated to the administration department, so we can add $8,000 to our table of administration costs. Totaling up the administration cost, we get $40,000. We can set up a table similar to the one we used to allocate rent and advertising costs to allocate the administration costs now. Administration costs are allocated based on the number of employees working in each department. Let's assume there are 6 employees in the hardware department and 9 in electronics, totaling to 15. We can find the percentage for each department by taking the number of employees, 6 or 9, and dividing by the total number of employees, 15. This tells us that 40% of the employees work in the hardware department and 60% work in electronics. Multiplying the percentages by the total administration cost of $40,000, we get $16,000 for hardware and $24,000 for electronics. The two values sum to the total administration cost of $40,000. Now we can finally complete the departmental income statements. We can fill in each department's share of the administration expenses, which we see here are $16,000 and $24,000. Totaling up the expenses, we get $97,000 for hardware and $118,000 for electronics. Taking the gross profit and subtracting the total expenses, we get the operating income to be $63,000 for hardware and $67,000 for electronics. This completes the departmental income statements for our example. There's just one more thing I want to mention. If the goal is to evaluate one department based on performance, many of the costs included in the departmental income statements are probably not relevant because the manager and employees in that department have no control over them. Most notably, the indirect costs and the share of service expenses. These really are uncontrollable costs. So instead, what we can do is prepare a report based on what is called the departmental contribution to overhead. The report begins the same as the departmental income statements with sales and cost of goods sold, but only lists the direct expenses of salaries and supplies. Gross profit minus the total direct expenses equals the departmental contribution to overhead, the total amount of money each department has available after direct expenses are paid to help cover the overhead of the company. Departmental contribution to overhead can be used to evaluate whether or not a department should be eliminated. As long as the departmental contribution to overhead is positive, the department in question should not be eliminated. Okay, that wraps up our example and our video relating to departmental income statements.